Well, good morning, everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong. I am a coach and senior manager with Schwab. I was in San Diego this weekend with about 600 of you. And Ben Watson was there, Kevin Horner was there, our travel team was there, and we were talking about technical analysis and intro to trading options. And when I get to speak with all of you, it's just a wonderful thing. And so today I thought we would talk about trading strategies. We're going to place a lot of example trades in this class today. They are all going to be bullish strategies. We're going to look at 3 different strategies on 7 different stocks. So we are going to be running through this class. But if you're brand new to this and there's a strategy you don't understand, please type a greeting into the chat so that we can kind of go over that strategy quickly so that you can kind of stay with us in this. I've got Connie Hill joining us in the chat today. She's a friend and a fellow coach. She understands all this stuff backwards and forwards. So if you have questions, don't hesitate to ask. I want to thank all the usual suspects along with the newcomers who show up each and every week. So to Joseph and Coco and Will and Jay and Sharon and Josh and JDLMI and the rest of the gang. Thank you all for being here. Richard and Rocky were the first 2 into the chat today, so you guys get a special star. But in any event, we've got a lot we want to cover today, and I want to talk a little bit about fear, greed, and FOMO. These are, I'm going to compress greed, and call it's part of my 4-letter word kind of group because these things do not serve us well when we're looking at trading. And so we're going to have a little bit of a conversation about that as we look at placing these new example trades. So if you are not following Connie and I in the Land of X, you are missing out. At Barb Armstrong CS and at Connie Hill CS. We're also on LinkedIn, so go find us there. Yeah, and it's just another way for us to be able to communicate with you and you to communicate with us outside of webcasts like these. So we do a lot of options trades in this class, and we're going to do several today. We'll see how many I'm able to get through. But know that options carry a high level of risk and aren't suitable for all investors. Know that, we're doing this for education and information purposes only. None of this is to be construed as a recommendation, but I encourage you to follow along in paper money because really that is a great way to learn, right? Right. And know that with paper money, which is brilliant because it looks like it feels like, smells like real money, but it's not. There are some nuances and differences. One is that in paper money, short option positions will never be assigned early. And that can feel a bit like a relief, and sometimes it can be a pain. But we do talk about if we were assigned early, how we might manage that. So if you are new to this, feel free to type a greeting into the chat so we can welcome you. But we're going to do a super quick market overview. We don't go into a ton of detail because Kevin Horner does a fabulous job 4 days a week. This morning he had Ray Kimbrell on with him. So go and check that out. That's recorded at the market open. We're going to place a bunch of new example trades. We don't have a lot of trades on right now. So a lot of trades have recently hit targets and a few have hit exits. So our trade management is going to be really quick and dirty today. Okay, so hello to the newbies. We're really glad that you are here. We started at the beginning of this year with $25,000 in an account. And there was a comment at one point last year, somebody said, it's ridiculous to think that you could make $100 a week on an account of this size. So we made it our goal. We said, what if we just wanted to take a portion of our account, like maybe you have a larger account, and you said, what if I just wanted to take a portion of it and create an income stream? And so our goal this year is to make $200 a week on average. And some weeks we've overachieved that. Some weeks we've been in the hole, but on average, we're kind of on track. And then we don't want to risk more than $500 to $550 on a trade. So we might go as high as risking $550. We're not going to go over $600. And our focus is on the short to intermediate term time frame. There's an expression I love, like we're in the moving business, not the storage business. Like I call it a dating strategy with these stocks. We're not looking in this class or for this portion of our example portfolio where we're saying we're trading 25,000. We're not looking for long-term buy and holds. We're looking for largely base hits, what we call base hits. So, and I'll explain that as we go. And we're trading both bullishly and bearishly as the market indicates. And so, what is the market indicating right now? Well, if we come out to the charts and we look at the S&P 500, we hit a new all-time high on June 2nd. So last Tuesday, the market hit a new all-time high. We had a big down day on Friday, but today we've got this Harami pattern, which if you're new to candlesticks, I'm teaching a class on candlesticks tomorrow and getting started with technical analysis. And this is called an inside day or a Harami pattern, which is considered a complete and a bullish pattern when it happens at a support level, which it's doing. We also today have this, doji candle, which means the bulls and the bears have been duking it out and are kind of at an impasse. The market is currently trading close to where it opened. If we look at the NASDAQ, similar, market hit a new intraday high again last Wednesday, closed at a new all-time high last Tuesday. And again, we have this bullish Harami pattern at a potential support level. And, if we come and, oh, sorry. So, it's live, right? If we come down here, we didn't come down to like this previous support level and we're bouncing today. What about our small caps? A similar picture, right? Hit a new all-time high last, Thursday? So Tuesday, Wednesday, Thursday, markets were hitting, or major indices were hitting all-time highs. And we hit a new intraday high on the Dow last Friday. And, and again, inside day today. And where's the VIX? I haven't looked at the VIX yet today, but I'm guessing it's falling. And it is. It's down 14% from where it closed on Fridays. Okay. And then if we look at, who's leading the pack, so why are we going to look at bullish trades today? Well, because the market is close to all-time highs. We had a pullback Friday. And, so if we come and we look at the sector indices, and then the market is bouncing today. And so we see, if we're looking at over the last 3 months, who's leading the pack? Technology, followed by communications. And so we're going to look at a lot of technology and communication stocks, and then who's leading the pack over the last 4 weeks? Again, technology. If we look at this sector, looks kind of similar to what has happened with the NASDAQ, right? Well, the tech sector makes up almost half the NASDAQ. And then healthcare seems to be coming around the bend. And, communications, little bit of struggle in the last month, but overall over the last 3 months has been strong. Okay, so one of the things that we talk about is the importance on trade management. And for those that are typing in to Sunny Funny, that I met in San Diego, I'm so glad you came and that we had a chance to meet and maybe have a bit of a conversation. So, and I get great ideas on kind of how to, what to emphasize. And I asked a lot of you what your favorite trading strategies were and why you like to trade the way you do, or what you're interested in learning how to trade. So and we talked about the fact that placing a trade is one part of the battle. Knowing how to manage it once you get in is the other. And so we had a short put on CSX. We hit our 80% target and we're out of that trade today. We only have 2 working orders. And at any given time, we might have, 10 to 20 trades or sometimes more on in this account. And right now we have 3. So when we look at NVIDIA, because we're not going to do any long calls today, but we have a long call on Apple and that's bouncing. But with long call verticals, I put in profit and loss here. And if we're up 50%, we have a target to exit. And we can see here's our target to exit. We manually will go in and close it if we're down 50%. But when oh, this is on NVIDIA. So when we look at NVIDIA, it's pulled back, but we've got this same Harami pattern today, which is a bullish pattern at a potential support level. So if I extend that line to the right, and so we've got some time. This doesn't expire until July 17th. So it hasn't met our exit target. So we're good to go on that. And then with Apple, we have a 1 ATR target. It's bouncing today. If it doesn't go up and hit that target, we'll move our stop up on that to $1 below today's low. Okay. Okay. So now we're clear to have a run at some new trades. So let's look at CSX. And this may be the only one we look at. That this is in the industrial, if you're not familiar with this company. So it's rail-based transportation services in Canada and the US. And we had sold a put on this. We're now out of this. Well, now today, this was up earlier and hitting a new all-time high. And we're going to go ahead with one trade on this. I'm going to clear this drawing set because we now are out of that trade. But this is a stock that's up 30% year to date. It's been, moving to the upside, and today it's hitting this new high. And so what we're going to do with this one, it's called a buy right covered call, where we're both buying the stock and we're selling a call. Okay. And if we're looking at, so what's the advantage of selling a call when it's hitting a new high is that we might get more premium for it. Now, for the call that we're selling, we're also, however, close to this all-time high on paying the stock, on buying the stock. So if we came out and we look at CSX and we come out to July, if we look at our example trading plan, and I'll show you where to find an example trading plan, does it trade more than 1 million shares a day? Check. Do we have a tight bid-ask spread? Here, well, it's 10 cents here. That's acceptable. We want it to be less than 10%. So here is 25 cents on $1.40, and so, we want it to really be closer to, we'd want it to be closer to 16 cents, but when these fill, we typically get filled close to the mark. Now, that isn't a guarantee, but if we said, well, we're okay with that, we'd accept that. Does it trade lots of volume? So our open interest is the number of contracts that were on the books when the market opened this morning. We have over 3,000 at both the 47.50 and the 50 strike. And so if we said, well, if we were to sell this 50 strike, we'd make 60 to 70 cents. And, might that be worth it? Well, it's trading at 46.95 right now. How much could we make if we did that? So if we're saying we're buying covered stock, the most we could make on this, if we're called out at 50, I'll just move this in a bit. The most we could make on this is $3.68, or $50 minus 46.33. So if we said, well, we could make $3.68 per share, and I divide that by what we're paying to get in, which is 46.30, that's 7.9%. So the question we have to ask ourselves is, Is a 7.9, a potential return of 7.9% acceptable for a trade we would be in for no more than 39 days? And if that isn't an acceptable level of return for you, then one wouldn't place the trade. But we now have $32,500 in this account, and like 31,700 is sitting in cash. So this is a way of employing some of this cash. Now our max position size on this is 5,000. And so are we honoring our position size? Yes. Now, we don't want to risk more than 500 to 550 on any one trade. So if we said, okay, here's our recent low is 44.79. So if I looked at 44.79 and I multiplied that by 0.97, if I put a stop 3% below that, our stop would be at 43.44. And we're buying in at 46.33. So we're risking about $300. Is that less than 500? It is. So if we're okay with that, we're going to change our advanced order to first trigger sequence. We're going to right click. We're going to create an opposite order. And we're going to make it a market order. Okay. This is not allowing me to change this. I don't know why. Sometimes when I travel, when I come back, Thinkorswim acts up for a day or two. I don't know why. I did log out and log back in again. But I'm going to make this a limit order. This is how I'm getting around it. I'm going to put in a conditional order to get out at our 43.44. By coming here to this sprocket, we're going to say we want to get out at 43.44. So it won't trigger the order to sell unless it hits 43.44 or lower. Okay, so we're saying, you know, wait until this trigger order happens. And I've hit save. And then if I make this number something lower, as long as it's above that number, it would sell. So I could make this number 40. Not that I expect. Now, if it gapped down, we could get out at a lower price, but it's saying sell it for at least this or more, and only sell it if CSX goes below 43.44. If you're new to this, this may sound a little confusing. What I really would rather do is have this as a market order. Okay. So the next one I put in, I'll try and put it in differently, but we're going to put this in our buy right covered call. And the most we can make on this is $368. So somebody is saying, you know, could we just buy a protective put? That's what we did when we did this on Nokia. And so we're going to do another buy right, and we'll look at a protective put on that one. Okay. Okay, so we're going to send that one in. And then we're going to come and look. So we've got CSX done, and that's one type of trade. We did one on Nokia. And this one for us, it wasn't a base hit as much. I would have considered that more like a bases loaded kind of trade where, we hit a triple or, we got a couple of runs batted in because we made about $450 on this trade. And remember, our goal is to make $200 a week over the course of the year. So to have a trade where, we took care of, virtually, 2 weeks in one, that one worked out pretty well for us. And we closed this one out early because we had, all but $25 of our max gain on that. And so that's how we chose to manage it. But this is a stock that's up 128% year to date. I mean, it's been extraordinary. And so we're just looking at if we clear the slate on this, Well, or we could just activate this drawing and move it. What if we did a buy right covered call and we moved it back up to like 17? So if I edit this and say, we're going to do another buy right covered call, only this time we're going to do it at 17. Okay. And we're going to go out to July. And actually it's July 17th. And we'll show that. And we're going to go ahead. We're going to buy that today. So I could, activate this and just move our little arrow over, because what have we got? This is considered a bullish configuration, candlestick configuration, this Harami at a support level. This red line is the 30-day moving average. And the goal here with this buy right, so we're going to buy shares of stock, and we can buy up to a $5,000 position. So, we can buy 300 shares, and the goal is to be called out. Now, if we're not called out, we still have the stock, right? And, where might we put if we wanted to do a protective put? Now, we could do a stop loss order, or we could come and say, well, if we were to do a stop, where might we put our stop? Well, maybe 3% below that recent low at 14. So 14 times 0.97, around 1350. So could we come and, maybe buy a protective put? Which was Trader Joe's question. And we could do that. And in fact, on Nokia the last time, we did do that. And, but protective puts aren't free. But if we look at this and we come out to July, and let's look at this first. So this has a really high implied volatility. And it's saying, the expected move here, the one standard deviation move, is $3.45, either up or down. And so if it does go $3.45 up, it would go through our strike, right? Because if our strike is at 17, it only, if it goes up, to 220, it would go through our strike and we would be called out. And so some might say, well, why would you want to do that? Why don't you just buy the stock? Well, because this is a dating strategy. And if we're looking to create income, and I, lately I've been saying it's, is this our Paris for Christmas fund or our buy a new car fund? Or somebody said, how about put gas in our car fund, or, pay off your credit cards, whatever that may be. You may want to be able to withdraw the cash while preserving the principal. And so this is just, I'm just trying to give us examples this year of how we might do this. And so if we look at this and we say, okay, well, is the juice worth the squeeze? If I were to buy covered stock, which is what Thinkorswim calls a buy right covered call, if we sell the 17, we're, the most we can make on this is $3.11. So if we could make $3.11 and we divide that by the cost of getting in, $13.89, that's a 22% return in 39 days. A 22%, let me just repeat that. So does that sound interesting to anyone? Well, it sounds interesting to me. So we're going to go ahead and place this trade. We're going to do that first trigger sequence. Right click. Let's see if it'll let me. Now it'll let me do a market order. Well, what the Sam Hill? We're going to make it good till canceled. Then we're going to come to our sprocket. So I will fix this other order. Oh, you know what? We're going to sell a protective put on this, or buy a protective put on this. So I'm going to cancel just this order. Now I have to cancel the whole thing. Cancel, delete. So we're just going to do this part. So we're buying covered stock. And then with our first trigger sequence, we're going to come back and say, now, if we did a protective put and let's say we did around the $13 mark, we'd be paying 71 cents for that. Okay, now if we went down to the 12, we'd be paying 40 cents. And it's saying like the odds of this being in the money are around 25%. This is probability of in the money. You've got a 46% chance it could come down and touch this theoretically. But if we do this 40, how much are we risking? So I'm going to come here. We're going to buy this at 40. So now if we were to exercise, if this really tanked and say it went down to $8 or $9, and the probability of that, as we can see here, is not high. The probability of it going down to being at the $8 mark come July 17th is 2.5%. But if we look at this and say, if we did want to exercise our right, how much would we be down? Well, we'd be down $1.84 plus the 41 cents. So $1.84 plus 41. So 225 times 3. Then we couldn't do 6 contracts. So if we said, okay, what if we did the 13 instead? So if we did the sorry. Can I just delete this one? I'm going to delete that one. I deleted the whole thing. If we did the 13 instead, what would we be risking? So, well, now it brings up the whole thing. Okay, let's just delete. So if we if we do the 13 instead, now we're risking 85 cents plus 71. 85 plus actually 75. So we're risking $1.60 times 3, 480. So now we can afford to do 300 contracts. Okay. So we're going to buy this put and we're going to do 3 of these. So now we've protected ourselves to the downside, and we've got a position size that's under 5,000. The most we can make on this trade is 942. That would be a grand slam at the bottom of the 9th, my friends. And we're going to put that in our buy right covered call group. Now, if we're not called out, and we'll talk about how to manage these as we go along. So with the last one, so let's go ahead and put this in. Okay, we're in on that one. On the last one that we did on Nokia, let's bring up Nokia. So here we did this. We opened this at we opened this one on May 11th at $12.98. The most we could make on this was $15. On June 1st, we closed it out at $14.74. So it was 26 cents away from our max gain, and we decided to free up the funds. We actually took a vote on it as a class. Okay. So now you've seen 2 examples of buy right covered calls. One we protected with a stop loss order, and the other we used a protective put. Okay, so let's go and look at SanDisk now. So this is in the tech sector. If you're not familiar with Nokia, it's another tech stock. But we're going to look at SanDisk. So SanDisk, and spoiler alert, we may see a lot of these types of patterns today. This stock is up like 593% year to date. And one of the comments that someone made is, I hate to sell something on top of something I bought because it limits my gain. And but when we look at this stock, this is now a $1,600 stock, which 9 months ago was a $67 stock. And so has it moved too far? But the trend is still uptrending. We've got a bull flag pattern here. We have this candle configuration that says, it is a bullish configuration. We can't afford to buy just a long call. And we couldn't afford to buy many shares of the stock. We could maybe buy 3 shares, but we could do a long call vertical. And so if we come out here to July and we said, well, if we did the 1640, 1650, it's trading at 1647. This is a $225 call. That's the cost of it. Now, does this trade more than 1 million shares a day? Yes. When we come out here, do we have at least 20 times the contracts we want to trade? Yes. We have a $10 bid-ask spread on a $220 option. Like we can't afford to risk, $21,000 by buying a call because we could lose all of it. And so what we're going to do is we are going to look at buying a vertical. Might that work? Well, we'd pay $590 for this vertical. So that's at the very top end, at 640 and 650, but it only has to go up by $2.80. And so we might say, well, we're bullish on this. We don't usually like to go out that far, but 590, we really don't want to go more than about 550. So then could we instead do the 1650 because it's almost at 1650 and the 1660. And now we're paying 460, which is in a snack bracket we can afford. And, if we come back to the charts and we look at the 1 ATR, on an average day, this stock moves more than $100. Like if we look at, hovering over today, over the last 14 days, this stock has on average moved $120. So is it a big stretch? Like it was recently at 1861. How recently? Last week. And so if we are correct and this continues to uptrend, what are the probabilities? Well, it's saying here you've got at the 660 strike, a 98% probability it'll hit it, at least a 43% probability it'll be in the money at expiration. And so if we're saying, okay, if we're willing to take that risk, we're going to take 480 times 1.5. So we want to get it out when it's trading at 720. And you might say 720, like, so we'd be making how much on this? Well, now it's down at 4. So we'd say we'd get out at 6. Well, it's all over the place. So if we could make 580, why would we only want to make 250? Because we don't want to be greedy. And if we can make a 50% return on a trade in under 39 days, is that acceptable? And, we might be able to make that if this really is uptrends this week. We could be out of this trade within a week with a 50% gain. And, that's not too shabby, right? And so this fear of missing out and greed, man, it can cut you off at the knees, because I was the person that wanted that $420 in profit. And you know how often I got it? Almost never. And so I thought, well, if I stop being greedy, and how about I put in a target at, geez, I need to stop talking and put this in, because like this thing just keeps going up, right? So it's at 580, first trigger sequence, right click, opposite order, 580 times 1.5. Now it's 870, 555. I'm going to make this 720. Okay, well, 250, 750. Good till canceled. We're just doing one of these, confirm and send. It's in our long call vertical bucket. Okay. And usually we try and have the strikes, we try and bracket them around where it's currently trading. This time, in order to honor our position sizing rules, we had to, go out the at the money in the first strike, out of the money. So let's look at Apple now. Okay, we're still on SanDisk. AAPL. Okay, so with Apple, it kind of consolidated here for a while, but it hit a new all-time high when last week, on Wednesday. And it's I would call this kind of a bull flag and a stiff wind. So could we come in when you have something like this that isn't doing the SanDisk like, running up the hill like some kind of crazy decathlete? Could we come here and maybe sell the 305? And the idea with a short put vertical, if you're not familiar with that, is we're going to sell a put. Now, when we sell a put, we're agreeing to buy the stock at that price. And so we don't really, we don't, only have 32,000 in this account. So we're going to sell a put at 305, and then we're going to buy a put at 300 to define our risk. So now our risk goes from $305 a share to $5 a share. But the most we can make on this then becomes whatever we can get paid for that spread. So let's say if we make $1.50, we sell it for $1.50, then the most we can make is $3.50. And what we're looking for when we do this is if we're going out 20 some days. So let's come out. This is such a heavily traded stock, 21 million shares. Again, if we come out to July 2nd and we say, if we do this 305, we've got a 30-cent bid-ask spread. So that's acceptable, 374 contracts. And so why aren't we going out to the monthlies? Well, I like your questions. Because we want time decay to be working for us at an accelerated rate. So if we're saying the most we can lose is $5 minus $1.32. So the most we can lose on this theoretically is 368. Oops. 132 divided by 368. So, our potential return on this is 35.8%, like return on risk for a trade we'd be in for 24 days. So that meets our level of acceptability. But because we're risking over $300, we're only going to do one contract. And we're going to put in an order to buy this back when we've got 80% of our max gain. Now, if we meet on Friday and we've got 60%, or we meet next Monday, or we've got 60 or 70, might we decide to close it out early? Absolutely. So we're going to go ahead and put that in. Now, some people might say, well, I don't want to buy it back until I've got 90% of my max gain. Well, you can make your trading plan whatever you want. So there's our short put vertical. And I say that this one is kind of sort of bullish. Why do I say that? Well, because as long as it stays above 305, so if my strike is here, as long as it stays above 305, we have a successful trade. So this is 305, 300, and it was what, July 2nd? So we can even be a little bit wrong in that we're neutral to bullish. If it goes sideways, we're fine. If it goes up, we're fine. And in fact, we'll probably reach our 80% of max gain faster. It can even come back a little bit. We've got, $8 worth of buffer. Okay. Okay. So that is Apple. Okay. Now, could we do a long call vertical? We could. But I wanted to demonstrate something where if something's going sideways, could we still benefit? Yes. Okay, so let's come and look at TSM now. And then I want to show you, oh, we don't have a lot of time left. Dang it. So, again, a stock that's uptrending, up a mere 40% year to date. We have this inside day today, bouncing old resistance. Looks like it's now acting as new support here. And, we could do a swing trade here, or could we just do another long call vertical? And again, at $400, this is kind of an expensive stock for us, with our risk profile, right? But could we come out here and say, well, we've got 200 contracts. We've got a 65-cent spread on a $23 option, so that's acceptable. Trades over 1 million shares a day. Could we do the 425 and the 430? And is there enough room? So it's 240. So that makes the math easy. We're going to say we're going to do 2 of these. We're risking 500. If and when this gets to 375, we want out, or if it gets down to $1.25, not going in the right direction. Good till cancel, confirm and send. We're going to put that in our long call vertical bucket. Okay. Okay, so let's go and look at, we had a couple that didn't fill here. And so we're looking at, this one is to open, SanDisk. Oh, that one filled. So the Apple one hasn't filled. We're saying we want $1.37. They only want to give us $1.32. Okay, be like that, then. Well, we're just feeling so generous today. So, okay. Now, what I wanted to show you was, if you haven't subscribed to the Trader Talks channel, you'll want to do that. And when you first come in, what it will show you is what's currently being taught. But if you come to playlists, and I'm going to get these reorganized, but if you come down to the trade management mini sessions, oops, I didn't mean to do that. Let me come back out. I must have hit play all. I've done this a few times. You think I'd know. View full playlist. So when you come in, the first thing you're going to see is all these shorts. They're all under 5 minutes on candlestick patterns, and we're going to get this reorganized. But if you come down to the bottom, there are these example trading plans. So there's an example trading plan for the buy right covered call. There's one for the long call verticals, and the short put vertical just aged out and came down last week. I'm going to re-record that either today or tomorrow, and it should be up by the end of the week. Okay, so with our long vertical, our stop is at a 50% loss. And why don't I put the stop, why don't I do an OCO order to get out either if it goes up 50% or down 50%? And it's because sometimes when the market opens, there can be a lot of volatility. And when so if I hit my target and I get out for a 50% gain, I'm willing to take that hit all day long. But what I found in my live account is sometimes I'd get stopped out for way more than a 50% loss. And then the market would settle down and I wouldn't have been stopped out at all. So we go through the laborious task. And I say that tongue in cheek because here's how long it takes. Here's our long call verticals. Is anything up close to 50%? No. Is anything down close to 50%? No. NVIDIA, we already looked at, it's down 32, but it's rallying today. Our review is done. Okay, so to avoid getting nicked out, we manage it that way. And we review them daily. So it's not a set it and forget it, but you could be going out to golf or walk your dog, have a look, and you're done in like 30 seconds. Even if you have 10 of them. You know, it might take you, if you have to take some action or want to look at the charts, might take you 2 minutes. So, guys, that's what I had for you today. One of the questions when there is a survey, and I don't believe there is today, but you know, we placed 5 new trades. So we did a long call vertical on TSM. We did a long call vertical on SanDisk. We did a buy right covered call with a protective put on Nokia, and we did a buy right covered call on CSX using a stop order. And then we did a short put vertical on Apple, which hasn't quite filled yet. So my ask of you as we wrap things up is to please hit the like button. It helps move this up in the algorithms on YouTube so more people can find this content. This will be archived and available typically within a couple of hours. I encourage you to follow along in your paper money. Hit the subscribe button. Follow Connie and I on LinkedIn, and then on X as well, of course. Connie Hill CS, Barb Armstrong CS. Thanks to Connie for her help in the chat. Thanks to all of you for showing up. If you've got any questions and you're watching this in the archives, just type them into the comment section below. I'll look forward to seeing you for getting started with technical analysis tomorrow at 2 o'clock Eastern. And James Boyd is up next, so stick around. Lots of great stuff still to come your way. Take care, everyone. Bye for now.